Study Objective 4 gets at cost, volume, profit analysis. So this is the study of the effects of changes in cost and volume on a company's profit. All right, the changes in cost and volume, how those things affect a company's profit. So there's relationships here. If costs change by certain amounts, profits change. If volume changes, that means how much we produce. If volume changes, that affects our profits. So we're going to start to look at cost, volume, profit now. The first thing that we have to kind of consider is that in Study Objective 5, we're going to introduce something called a CVP income statement. It's basically a new way of looking at an income statement where we categorize our costs as variable and fixed instead of just listing out all the specific costs like we've seen in prior income statements. And what we're going to see in this CVP income statement is this new subtotal called contribution margin. And this relationship between sales, variable costs, and contribution margin is very important in CVP analysis. So we're going to look at contribution margin and in per unit terms and also in percentage terms. Here you can see a contribution margin per unit. You've got a unit selling price of $500, unit variable cost of $300, and the contribution margin is $200. When you kind of plug this back into the into this example that the text is going over, you can see they give you some data here. You can figure out the total CVP income statement by applying those per unit amounts. So sales would be $800,000 at that sales price per unit. Variable cost would be this. Contribution margin would be $320. So we can look at that and know we've got a contribution margin per unit of $200. Contribution margin is simply sales minus variable costs. And looking at this as a percentage, you can also say contribution margin is 40% of sales. 320 divided by 800. While we're here, you can say also that variable cost is 60% of sales. So since we talked earlier about variable costs being consistent at every level of activity, those percentages then will stay the same. So, depending on, it'll change numerically from year to year, but your contribution margin percentage and your variable cost amount can be counted on, at least in the problems that you're going to work, to stay the same throughout the problem. So contribution margin per unit, contribution margin ratio is what we call that percentage. So 200 divided by 500 gives you 40%. It's the same idea as we saw up here. 200 divided by 500, that's 40%. It's the same ratio in total dollars. 320 divided by 800 is 40%. And we're going to use those per unit and percentage amounts in figuring out break-even analysis, which comes in Study Objective 6.